Good morning. Today we are going to talk about commercial banks and their management. Let's start with defining what's meant by a commercial bank. Commercial bank is an intermediary or is a depository institution. Its main function is to receive all types of deposits and make different types of loans. So we can define it as a financial institution that receives all types of deposits and make all types of loans. What are the different types of deposits? Checkable deposits, or known as demand deposits. This is number one. Number two, saving deposits. And number three, time deposits. What is the difference between the three different types of deposits? With respect to checkable deposits, they are deposits in which we can write checks. There is no or zero interest rate on a checkable deposits. While in case of saving deposits, you cannot write checks and you are going to receive an interest rate. Number three, time deposits. It has a maturity date and it has the highest interest rate if you are going to compare it with the checkable and the saving deposits. So we can take that the three types of deposits: checkable, saving, and time. If you are going to compare between the three types, a checkable can write checks, saving you cannot write checks, and with respect to time you cannot write checks. With respect to maturity, checkable deposits has no maturity date. They are payable on demand. Saving, there is no maturity date, but usually saving deposits are going to last, to stay or to be available in the bank for longer time period compared to checkable deposits. While with respect to time deposits, it has a maturity date. With respect to interest rate, no interest rate or very little. It's almost zero. While in case of saving deposits, the interest rate is higher than a checkable deposit. And with respect to time deposits, the interest rate is higher than saving and checkable deposits. So with respect to commercial banks, they make all types, sorry, they accept all types of deposits. Banks are going to use checkable deposits to make all types of loans. What are the different types of loans? Consumer loan, mortgage loan, and business or investment loan. Consumer loans, they are loans in order to buy consumer goods and services, such as buying a mobile phone on credit. This is a consumer loan. While mortgage, you are going to buy a building or a land. In case of business or investment, you are going to make a new project, new investment project. So commercial banks will accept the three different types of deposits and are able to make the three different types of loans. Now we would like to study the commercial bank's balance sheet. Loans are the basic assets for commercial banks. They are considered to be liabilities for the lenders, but an asset for the commercial bank, while deposits are liabilities for commercial bank and asset for the depositors. What are the main elements of the commercial bank's balance sheet? Let's mention them and then explain each one of them in detail. Number one, this is assets and this is liabilities. The main assets are reserves, other cash item, securities, loans, and finally fixed assets. With respect to liabilities side, it includes deposits, borrowing, and it can be divided into borrowing from other banks and borrowing from central bank. capital, and this is total liabilities. The balance sheet identity is held for banks, which means that total assets equals total liabilities plus capital. In case of banks, owner's equity is known as capital. So the accounting identity or the balance sheet identity of any bank is total assets equal total liabilities plus capital. So from this we can conclude that banks are going to get sources of fund from deposits and borrowing. Use this money in order to buy assets in the form of securities, loans, keep reserves, and other cash items. So bank assets are use of funds, while bank liabilities are the source of funds. Let's start with the use of funds or bank assets. What's meant by each one of them? Number one, reserves. Items are recorded in the balance sheet based on their liquidity, which means that the most liquid assets are listed first, and then the least liquid one, and finally the least liquid. This means this is the most liquid asset, and then as we move downward, it's less liquid, least liquid, and so on. What's meant by reserves? Reserves are liquid money kept by the bank to meet deposit withdrawal. Reserves are held at the bank itself or deposited at the central bank. Reserves can be held at the bank or deposited in the central bank. If it's held by the bank itself, it's known as vault cash. There are two different types of reserves, or total reserves can be divided into two main types. Required reserves and excess reserves. Required reserves are reserves that the bank is obligated by law to keep. This means that the central bank is going to announce a ratio, a required reserve ratio. This is made obligatory by law. Required reserves of what? Required reserves of uh, um, bank deposits. So we would like to keep a percentage announced by the central bank, percentage of deposits. This percentage is known as required reserves. So required reserves can be calculated as required reserve ratio multiplied by total deposits. Required reserve ratio is announced by central bank. What about excess reserves? Excess reserves are all additional reserves kept by the bank in excess to the required reserves. So total bank reserves, which is R, is the summation of required reserves and excess reserves. For example, if the required reserves is 100 and the bank manager is going to keep reserves of 150, so we have excess reserves of 50. This means that total reserves kept by the bank are 100, which is the required one, plus 50, which is excess reserves. So total reserves is 150. Item number 2, which is other cash item. In case of other cash items, it consists of two main components. Cash items in process of collection and deposits at other banks. Cash items in process of collection are checks written on accounts in other banks, deposited in the bank, but funds haven't yet been collected. Are checks written on accounts in other banks, deposited in the bank, but funds haven't yet been collected. For example, Gugu and Nino, each one of them has an account in a different bank. Nino write a check for Gugu with 50,000. His account is in bank B, and Gugu's account is in bank A. So what's expected to happen is that Gugu is going to bank B and withdraw the money, and then go to bank A and deposit the money. But actually, we are not going to do this process. What's going to happen is that Google is going to deposit the check in her bank and ask them to collect the money from bank B and then deposit the money in her account. For now, a check are found in bank A. They haven't been collected yet. So these checks are cash items in process of collection. They haven't been collected yet. After collection, they are going to be reserves. But for now, they are in process of collection. What about deposits at other banks? Commercial banks, instead of keeping money with them, they are going to deposit this money in other bank. This is bank A and bank B. Bank A has an excess reserves or excess money, so they are going to deposit this money in bank B in order to get the interest rate. Bank B can be inside the country or outside the country. Item number 3 in the balance sheet which is loans. Is the biggest source of fund to the bank. Is the biggest asset item in a commercial bank. Sorry, is the biggest use of fund, not source. Is the biggest asset item. As we said, we can classify them based on the use or the maturity. Consumer loan, business loan or investment loan, mortgage loan, or based on the maturity, whether it is a short term, based on use, consumer, mortgage, and business. While based on maturity, it can be short term, which is less than 1 year, intermediate term, from 1 to 10 years, and long term, more than 10 years. The fourth item in the asset side is securities. Securities are debt instruments. Securities means bond and stock purchased by the bank to yield a return. So it's a kind of an investment made by the bank in order to get a return or to get a profit from this investment. Profit received from securities are one of the major sources of banks' income. Securities are highly liquid. As a result, it's well known as secondary reserves. So we can call securities a secondary reserve as it is highly liquid asset. Finally, item number 5 in the asset side is fixed assets. They are real estate, furniture, computers, ATMs, and so on. This is the asset side of the balance sheet. Now we are going to move on to the liability side or sources of funds. As we said, that's the most important source, which is checkable, which is deposit. And we said that there are three different types of deposits: a checkable, or known as current account, or known as demand deposits. There is no restrictions on withdrawal from this account. You can write checks. There is no maturity. There is no interest rate or very low interest rate. And the second type, which is saving deposits, it uh, it, it hasn't a fixed maturity date, but there are some restrictions on withdrawal. And finally, time deposits. It has a fixed period of time or maturity date, say annual or 5 years or 10 years. It has the highest interest rate. So this is source number one. Number two, which is borrowing. Commercial banks can borrow from other commercial banks or from central bank. If they are going to borrow from other banks, the loan is known as interbank loan. and the interest rate that's gonna be paid for this loan is known as interbank rate. While in case of borrowing from central bank, the loan is known as discounted loan, and the interest rate is discount rate. Finally, the last item in the liability side is the capital. Capital is the residual or the difference between total assets and total liabilities. It's shareholders' money invested in the commercial bank. Okay, let's take an example. If you know that checkable deposits are for 100, cash item, cash with the central bank, sorry, cash with the central bank is 90, corporate bonds 50, consumer loans 50, business loans is 150, government bonds is 100, fixed assets is 20, borrowing from central bank is 20, borrowing from other banks 60, and finally vault cash is 30. Required is to construct the balance sheet of this bank. First of all, we have to write the items as written in the balance of payments, not in such a way, which means that we have to write it as reserves, reserves, other cash items, securities, loans, and so on. Okay. Other cash, securities, loans, fixed assets, and with respect to liability side, deposits borrowing from central bank, from other banks, and from central bank, and then finally capital. Okay, reserve is 400. Sorry, checkable deposits 400. So this is 400. Borrowing from central bank is 20 and borrowing from other banks is 60. So this is 60 and 20. Cash with central bank. This is reserves. Vault cash is reserves. So the summation of both of them is total reserves. So reserves will be 120, which is 90 plus 30. Fixed asset is 20. Corporate bonds and government bonds or securities. So securities will be the summation of 50 and 100. It will be 150. Consumer loan and business loan or loans. It will be 50 plus 150, which is 200. Other cash item is 0. So the total summation of total assets will be 200, 350, 470, 490. 490. While with respect to liabilities side, it's 400 plus 60 plus 20, which is 480. This means, and as we said, that balance sheet identity should match, which means that assets should be equal to liabilities plus capital. So we can find the value of capital as the difference between assets and liabilities. So it's 490 minus 480. This means that capital will be 10. This is in order to have an equivalent value for assets and liabilities and the owner's equity side. This is the end of our lecture today. Thank you.